Welcome back to Lesson 2 of the Value Investing Bootcamp, in which I will tell you why you are probably better off investing your own money instead of having an advisor do it for you, since what is good for your advisor may not necessarily be good for you. At first sight, it seems like a great plan to let someone manage your investments who is, or at least appears to be, more knowledgeable on the subject than you are. Unfortunately, an advisor is not really interested in making you a lot of money. He is interested in making a lot of money for himself. As you can see, this is a structural conflict of interest. The fact is that an advisor earns a commission for every trade that is made. In other words, the more times you buy and sell stocks, the more money the advisor earns. Whether you are making money or losing money has no impact on the compensation of the advisor. Therefore, there is a bias towards frequent trading and not necessarily profitable trading. Advisors simply get paid for what they do, not how well they do it. There are stories of advisors who knew nothing about stocks whatsoever. They were simply salesmen trying to earn their commissions by getting clients to buy and sell as often as possible, completely ignoring the consequences for the hard-earned savings of their clients. The way advisors often play this game is by telling their clients that they have to protect their portfolio from significant losses by buying a diverse set of stocks, thereby scaring clients into over-diversification of their portfolio, which means a lot of trades have to be made in order to purchase all these stocks, which in turn means a lot of commission for the advisor and a lot of transaction costs and fees for you. In a later lesson, we will see that minor diversification is often sufficient to spread the risk of your portfolio, as long as you know what you're doing. Of course, not all advisors are evil, but it is important to be aware of the fact that the incentives of the advisor, which are fees and commissions based on the amount of assets under management and the amount of trades being made, are not aligned with the thing you want: good returns on investment. However, even if you would have the luck to find a completely honest advisor who really does try to earn you money, there are still many reasons why you might be better off without him. Why? Because most advisors, as well as the majority of professional fund managers for that matter, only manage to earn mediocre returns at best, not the mind-boggling returns most value investors are able to earn. The cause of this is a short-term, relative performance orientation. Let me explain. Because clients continuously want to know how their investments are doing, advisors have to share the performance data with their clients every year, every quarter, or sometimes even every month. And at the end of every period, clients want to see a nice profit, or they might switch to a different advisor. This creates an immense pressure on the advisor to show a positive result every single time, which creates a dangerous short-term orientation. Remember from lesson 1 that short-term price movements are impossible to predict. Therefore, the investment strategies of the advisors have to be largely based on luck, hoping that prices rise because someone is willing to pay more for the same stock, rather than because the underlying company is actually creating value. This obsession with showing short-term profits also causes them to lose sight of the downside risk. Besides the short-term orientation, the focus lies on relative rather than absolute performance. This means that the results of the advisor's investments are compared to an index, like the Dow Jones Index or the S&P 500. The goal is to beat the market, or in regular English, earn a higher return than the overall stock market. While this is an admirable goal, trying to beat the market in the short run might cost you dearly in the long run. And thanks to the power of compounding, which we briefly discussed in the previous lesson, we know that the long run is where the real money is made. Comparing your returns, or the returns of an advisor, to the returns of the stock market reinforces the short-term orientation and is therefore counterproductive. But besides comparing themselves to the overall market, advisors also compare themselves with other advisors, which creates an environment in which everyone is copying everyone else because they are afraid to stand out from the crowd when things go wrong. There is safety in consensus. For example, if one advisor tried something bold, like not buying tech companies during the dot-com bubble, like Warren Buffett did, while all of his colleagues were buying every tech company they came across, His returns would have been lower than theirs for several years, and he probably would have been fired before his strategy would have eventually earned him and his clients a nice profit, while the returns of his colleagues would have been smashed during the crash. This copycat behavior ensures mediocre returns at best, because as the legendary investor John Templeton once said, if you want to have a better performance than the crowd, you have to do things differently from the crowd. Value investors buy great companies at low prices, and in lesson 1 we learned that this requires a contrarian approach, often buying stocks nobody wants to own. Therefore, it can take a significant amount of time, sometimes several years, before your stocks actually rise to their true value, earning you a handsome profit in the process. This means that value investors often underperform in the short run, but massively outperform in the long run, and this end result is all that matters. For example, Warren Buffett was laughed at for underperforming during the dot-com bubble of 2000, but he had the last laugh when value finally won out over euphoria when the market came tumbling down. Let me give you a quick example from my personal experience. I owned United Insurance Holding at some point. This company had so much cash that if it would go bankrupt the day I bought it, I would still make a profit. Also, it had a huge dividend yield. Nevertheless, the stock underperformed the market for 3 years in a row, after which it finally earned me a 155% return. Even though this took several years, the average return was still way above average. So again, be patient, because time is your friend on the stock market. If you consistently follow a sound investment strategy, the profits will come naturally over time. So we just covered why advisors might not be the best persons to handle your money. Fortunately, it isn't that hard to do it yourself. Seriously, you can do it. You can consistently earn amazing returns on the stock market, but you will have to put in some effort and really stick to the strategy. Peter Lynch said, "Everyone has the brainpower to make money in stocks. Not everyone has the stomach." The fact that you are following this course already indicates that you are interested in learning how to invest your own money. Perfect, because that is exactly what you will be able to do at the end of this course. All you really need are 3 things: a brokerage account, some money, and an investment strategy that works. A brokerage account is nothing more than a fancy word for a special type of bank account from which you can buy and sell stocks. I highly recommend Interactive Brokers, and it's not just me. The highly respected financial magazine Barron's rated them #1 broker for 3 consecutive years now. Interactive Brokers offers great service, many advanced functionalities, a huge selection of stocks to choose from, and relatively low transaction costs. Still, do some research of your own before making a decision. In Lesson 4, we'll talk about the ideal amount of money you should invest. If you are still a bit hesitant to invest with real money, there are many ways to practice investing with virtual money. I highly recommend this to every beginning investor. The service I prefer for this is Google Finance. To open a virtual portfolio, go to finance.google.com. Search for a company or ticker symbol. Now, in the top right corner you can click Add to Portfolio. If you click Add Transaction Data, you can even input a purchase price and amount of stocks. This allows you to track the performance of the stock and the returns it generates for you. It is like real investing, but with 0 risk involved. It is totally free and virtual. However, you learn a lot from it. To summarize, there is a structural conflict of interest between advisors and their clients, you. Advisors are primarily seeking to maximize commissions and fees. Advisors focus on frequent rather than on profitable trading. You should probably avoid even honest advisors, because they tend to earn you only mediocre returns. The cause of this is a short-term relative performance orientation. Value investors regularly underperform in the short run, but come out as the clear winners in the long run. You don't need an advisor, because you can quite easily do it yourself. You can practice investing with 0 risk involved by opening a virtual portfolio. In the next lesson, you'll learn why most investors lose money on the stock market. This is crucial information because avoiding where others go wrong is one of the most important steps in achieving investment success.